welcome you. Today on the deep dive, we're diving into the messy economic picture right now.
Yeah, certainly complex.
We've looked at a whole bunch of recent expert takes, everything from, well, what the Federal Reserve might do next to the global currency situation, potential big shifts coming.
hmm
And our mission today, it's pretty straightforward. Pull out the really critical stuff so you can grasp what's happening, what it might mean, without getting totally overwhelmed.
Sounds good.
And helping us navigate all this is Christopher Wan, chairman of Wan Global Advisors, author of Inflated Money Debt and the American Dream. Your expertise is right on the money for this U.S. monetary system, Fed moves, global economy stuff.
Great to be back. Ready to jump in.
Okay, so let's get straight into it. This situation with the Fed, it feels pretty muddled, doesn't it?
It really does.
You've got these strong arguments on both sides, cut rates, don't cut rates. We even heard Christopher Waller saying cuts are, well, essential. And then, boom, the European Central Bank actually goes and does it, reduces rates. What's your first read on this apparent conflict?
Well, what's really fascinating, I think, is this fundamental tension the Fed's dealing with.
Okay.
Because, yeah, some economic signs look okay, maybe even strong on the surface. But underneath, there's this big worry about deflation.
Deflation, even with inflation still being talked about.
Yeah, potential deflationary pressure.
Yeah.
It mostly comes down to just the sheer amount of debt sloshing around, especially, commercial real estate, private equity. A lot of that got financed when rates were basically zero during COVID.
Right, cheap money era.
Exactly.
Yeah.
And now they're facing refinancing those deals at much, much higher rates. So that's a looming problem.
Okay, so that's the pressure point. But what about the consumer? We kept hearing about a looming recession there.
Well, interestingly, that consumer recession everyone was predicting hasn't really shown up, not in the bank credit numbers anyway.
Huh. So the average person is holding up better than expected.
Seems like it, based on that data. So like you said, the Fed's in a really tricky spot. Delicate.
And Powell talks about being symmetrical.
Right. Which basically just highlights how uncertain things are. They don't really know which way they'll jump. Depends on the incoming data.
He's keeping his options open, essentially. So, okay, trying to read the tea leaves here in this muddle. What do you think is the most likely path? And what kind of domino effects should we be watching for?
Well, if we connect this back to the wider economy,
Mm-hmm.
rate cuts, if they happen, it's complicated. Benefits and risks.
Okay.
For your regular banks, lower rates could actually help a bit, give them some breathing room.
All right.
But for the non-banks, the shadow banking sector, you could see this asset evaporation problem.
Explain that.
Basically, if rates fall, people with existing mortgages rush to prepay them and refinance at the new lower rates. So those mortgage assets kind of vanish from the non-banks' balance sheets. We saw some of that back in 2020.
Okay, I see.
But all this is happening, remember, against that backdrop we just mentioned, the pretty significant distress that's starting to show up in commercial and multifamily real estate.
And you called multifamily the subprime today. That's a pretty stark comparison. Why draw that parallel?
Well, the scale of government involvement is just huge. About 2/3 of that market has some kind of government guarantee or backing.
2/3, wow.
Yeah. And remember those easier delinquency rules they had during COVID for government-backed loans? Fannie Mae, Freddie Mac? Those are expiring or have expired. They're going back to the pre-COVID rules. So you're almost certainly going to see a big jump in homes hitting the market because of foreclosures.
More supply coming online then.
Potentially a lot more.
You're saying?
And there's this kind of grim statistic floating around.
Yeah.
It suggests maybe 60%, 60, of current home sales are people just leaving the market altogether, not buying another place.
Really? What's normal?
Historically, it's been more like 10, maybe 15%. So, yeah, you can see how that points to a potentially major shift in housing.
That definitely sounds like pressure building. Okay, so if rates do come down eventually, what does that do to the U.S. dollar? It's been pretty strong lately.
Yeah, the dollar's strength recently, that's mostly down to the Fed hiking rates, right? Makes dollar assets more attractive.
Sure.
And historically, the dollar's been the global currency. Over 80% of foreign exchange deals use it.
The king.
Right. But if the Fed starts cutting rates, that whole dynamic could start to shift. There's also this viewpoint bubbling up.
Okay.
That maybe the current administration, long-term, wants to kind of move away from that whole post-World War II Bretton Woods system.
Where the dollar was cemented on top.
Exactly. The idea or the theory is maybe aiming for a more multipolar financial world, where the U.S. is still important, obviously, but maybe less totally dominant, a bit like before World War I, perhaps.
Interesting. What were the pros and cons of the dollar being this, global utility for so long?
Well, that's the crucial trade-off, isn't it? On
Mm.
one hand, sure, it provided stability for global trade, for finance.
Yeah.
But on the other hand, you could argue it's also exported inflation, or at least contributed to it for U.S. consumers and businesses.
Hmm.
Global demand for dollars keeps its value up.
Makes imports cheap, but hurts exports.
Sort of, yeah.
Yeah.
It makes U.S. stuff potentially more expensive overseas.
Yeah.
So, moving away from that kind of system, it's not a quick fix. And it begs the question if other countries, the whole global setup, are really ready for that kind of massive change.
Right, it's a huge ship to turn. We've also heard talk about this administration maybe having a more conservative and righteous view on things like credit, financial regulation. How might that actually play out?
Well, thinking about the potential impact,
Hmm.
you could see maybe tougher regulations on the traditional banks,
Okay.
but maybe a lighter touch on the non-banks at the federal level,
Yeah.
pushing more of that oversight down to the states.
Different approach.
Yeah, it'd be a definite contrast to the previous administration's policies,
Hmm.
the sort of throwing money into the street approach, which
Hmm.
arguably left a bit of a mess in housing and, well, at the FDIC with things like Signature Bank's assets.
Right.
We should probably also expect a return to a more normal term structure for interest rates.
Meaning the gap between short and long-term bond yields.
Exactly, that normalizing.
Yeah.
And likely higher risk premiums being demanded on longer-term U.S. Treasuries, people wanting more compensation for holding that long-term government debt.
And is that already happening?
Interestingly, yeah, those spreads had already started widening a bit even before the recent election talk heated up, so it might be a pre-existing trend getting stronger.
Okay, and you mentioned this idea of a dollar trade-off that the administration might actually like. Why would they want a weaker dollar potentially?
Well, the thinking there is it could really boost the competitiveness of American industries globally. For ages, a strong dollar has kind of put U.S. companies on the back foot compared to firms in countries with weaker currencies.
Yeah.
Made American goods seem pricier.
Yeah, makes sense.
So a weaker dollar could flip that script, make U.S. exports cheaper, more competitive, maybe drive some export growth.
Okay, so it helps certain sectors.
It could. And it also ties into the U.S. fiscal mess.
How?
Well, a weaker dollar makes imports more expensive. That might, just might, force Congress to face the music a bit more on their spending habits.
Because things cost more.
Yeah. Historically, let's be honest, the U.S. has preferred borrowing over, tightening the belt and paying the bills.
Sure enough. So, given all these shifts, all this uncertainty,
Yeah.
are we just headed for a big crash at some point? Is it inevitable?
Look, a big, sharp crash. It's not necessarily the only outcome. It's possible, sure. But there's another path. The Fed could essentially choose to hyperinflate
Whoa, explain that.
by aggressively monetizing federal debt, just, creating money to buy up government bonds and cover the bills.
Like you mentioned the Argentina example.
Sort of like that dynamic, yeah. Where there's huge societal resistance to cutting spending or consumption. Makes real fiscal fixes incredibly hard politically.
And is the Fed actually thinking about this stuff?
Well, there are reports suggesting they're already making contingency plans, preparing for potential bailouts or interventions if things get rocky.
Okay. You also flagged the U.S. Treasury market itself as being potentially fragile. Why is that market specifically a concern?
Yeah, if you dig into how that market actually works, research suggests it was kind of carefully built by the Fed starting back in the 50s.
Right.
And it relied heavily on a group of primary dealers, big banks, to keep things running smoothly.
Right.
The problem is we lost about half of those dealers in the 2008 crisis. They merged or disappeared.
Fewer key players now.
Right. And today, a huge chunk of the Treasury market is basically a giant carry trade run by hedge funds using a lot of leverage.
So it's built on borrowed money, essentially.
To a large extent, yeah. And for the Fed, keeping that Treasury market open and functioning, that's arguably their absolute number one job, their biggest mandate.
So what does a break in that market look like? Not a total collapse, you said.
Probably not a sudden, complete meltdown. More likely, it means government borrowing costs shoot up significantly.
Okay.
And it forces a change in who holds all that Treasury debt.
Yeah.
You might see banks being basically forced to buy more government bonds.
Which is what you called financial repression.
Exactly. We saw something similar after World War II. Banks ended up holding like half their assets in government bonds because they had to.
Wow. And what does that do to banks long term if they're forced to hold low-yielding government debt?
Well, it likely just makes that existing trend worse, the one where returns on traditional bank assets keep falling.
Right.
And it speeds up the shift where the interest income flows more towards the bank's shareholders, the equity holders, rather than the actual depositors.
So savers get basically nothing on their deposits.
Pretty much. While the shareholders might do okay, is a continuation of that pattern.
Okay, let's pivot a bit to the bigger global picture. Lots of talk about a potential reset of the monetary system, the decline, or you said atrophy and decay of Bretton Woods. What does that actually mean?
Well, Bretton Woods, remember, that was the system set up after World War II. It basically put the U.S. dollar at the center of everything and officially moved away from gold being the direct anchor for all currencies.
Got it.
But that system's been, slowly eroding and changing for decades. It wasn't static.
Okay.
And there's a growing feeling, not just in the U.S., but globally. I think the Spanish finance minister even said something about the dollar imperium ending eventually, even without Trump pushing it.
So it's a wider trend.
Seems like it. We're
Yeah.
probably heading towards a more multipolar financial world, different power centers, competing currencies, maybe regional blocks becoming more important.
And is that why countries like Russia and China are buying up so much gold?
That's a big part of the logic, yeah. They see the writing on the wall, perhaps. Gold becomes a potential hedge, an alternative store of value if the dollar's role diminishes, a backstop.
So what role could gold actually play in whatever comes next? Is it back to the gold standard?
Probably not a full return to gold convertibility, no. Not in our current fiat system.
No.
The sheer amount of gold needed just isn't there relative to the global economy.
Okay.
But gold could play, symbolic roles, educational roles.
Yeah?
Remind people about tangible value. There are ideas like Judy Shelton talked about gold-linked bonds, or Jim Rickards suggested the Treasury should just buy gold regularly, things like that. More symbolic or marginal roles.
So the recent gold price surge isn't about gold itself being amazing.
It seems much more a reflection of dollar weakness or anticipated weakness than some fundamental new strength in gold itself. It's relative.
Gotcha. What about the BIS, the Bank for International Settlements? Could they give gold a more official role?
That's definitely possible. There's talk they might eventually recognize gold as a high-quality liquid asset.
Which means...
It would make it eligible collateral for things like international currency swaps between central banks. Give it a bit more plumbing level importance in the system.
Okay. But despite all these potential shifts, the dollar isn't just going to disappear overnight, right? What keeps it attractive?
No, definitely not overnight. If you step back, the U.S. still has some major advantages. Just the sheer size and liquidity of U.S. financial markets. Nothing else really compares. There's also a degree of confidentiality for investors and, critically, a relatively stable rule of law.
Things people trust, basically.
Yeah, relatively speaking. Those attributes are harder to find consistently elsewhere, compared to China. Despite its economic size, there's still fundamental lack of trust in the Communist Party, the state control over finance.
Yeah.
It makes the dollar look pretty good, even with its own issues.
So even if the BRICS nations rise?
They're definitely rising economically, no question. But will they develop those same attractive features for global investors?
Yeah.
The deep markets, the trust, the legal protections, that's the big open question.
This has been, wow, a really deep look at a super complex picture. Things are definitely changing fast. For our listeners who might be feeling, I don't know, a bit of shock and awe, maybe,
Understandable.
what's some practical advice for just navigating this period of uncertainty?
Well, one thing that seems different this time, potentially, is that the incoming administration looks maybe more prepared, with a more detailed agenda than perhaps in previous transitions.
Okay.
So my main advice is pretty simple. Do your homework.
Meaning?
Think hard about assets you might have wanted to own but thought were too expensive. Watch for market adjustments. There might be better buying opportunities coming. Be patient.
Wait for the dust to settle a bit.
Something like that. Also, expect that new trade deals will eventually get done, probably with close allies first. China and maybe a few others will likely remain the big sticking points, the focus of policy.
Any signs of stability we can look for?
Well, the talk about potentially bringing in people with a serious Wall Street experience, like maybe Scott Bessent for Treasury Secretary, that could be seen as a stabilizing influence, someone who understands the markets deeply.
Okay.
And maintaining solid ties with key allies, that's going to be absolutely vital. We might also see Europe stepping up more, taking more responsibility in areas like, say, Ukraine.
But relations with some countries could get rockier.
Probably with China, yeah. If their perception is they're engaging in predatory mercantilist behavior, expect relations to be pretty contentious.
Got it. And you mentioned your book for people who want to go deeper.
That's right. For anyone wanting to dig into these themes more, the debt, the monetary
Mm.
system, the historical context, the revised edition of Inflated Money Debt and the American Dream is out soon, May 16th, actually.
Excellent. Well, this has been incredibly insightful, a real deep dive into just a hugely multifaceted and shifting economic world.
My pleasure.
It's clear there are massive forces at play, and just staying informed feels more crucial than ever right now.
Yep.
So, as we wrap up, here's a final thought maybe for our listeners to chew on. Considering these historical cycles of economic power and, the built-in problems in the current system we've talked about, what often overlooked factor or factors might actually end up being the real decider for the future global financial order. Something to think about as you keep exploring all this. Thank you so much for joining us for this deep dive.